Hi, this is Paul from globaltradingsoftware.com, and this is a trading tutorial for the harmonic patterns within our day trading bundle. I want to look at copper on the 1 hour, so this is longer term plays. But before we even think about signals, confirmations and trading and trade management, I want to show you how I've actually put the framework for this trade together. In other words, the support and resistance zones. Very, very important. So first of all, you see this crab pattern complete in the automated completion zone. So that's the first big tick in the box. But what we then need to do is look where this A pivot was and this C pivot was on this current candle. And that forms a zone where we want to make sure we're getting in below there. Okay, that's one of the things for me is I'm looking for a longer term play, especially when I'm going short on something like copper. Now, where do the other ones come from, and does this one happen to be support resistance for future back? We've got to look left. So let's look left. I'm going to zoom out a little bit because I want to show you, and I've highlighted all of these with the little ellipses. So this A and C pivot that we've put on to begin with, which is our starting point, our start line if you like, to make sure we're below. Actually this was tested as resistance massively before, and a big A pivot on this crab pattern that completed down here and had a great move up. So this is a great zone that we've identified here. But also we look at previous harmonic patterns and big pivots to give us some more trade management type of areas, so where we're going to find support if this does go down. So we've got a bat pattern here where the start of the pivot is there, and we've got another A pivot and the C pivot for that. So two different pivot points for this Gartley, this bat pattern at that point as well. We got tests here, we got tests here, and we've got a big rejection into there. So this is a good zone. So this is where we would expect some sort of support and resistance. And then a little bit further down we've got this big A pivot from this butterfly pattern here, and then we've got these lows on this pivot as well. So that gives us, that frames us the chart. So that gives us some linear support and resistance zones to firstly look for a start line, an entry for a harmonic pattern, and also then for potential areas of trouble. Potential. So let's look at the trade. I can't play this back because it's on copper and you can't play back on this trading view. So I'm going to work through this trade and talk through how to do it, because it's important to look for good examples and to really discuss what's going off. So the first thing we've covered, those support and resistance zones. The start line's got to be below this A pivot for me, because it's a very narrow crab pattern here. We've got a small range between the start of this pattern and the completion. It's completed in the automated completion zone, so that's the biggest thing for me straight away. Now the next thing with the day trading bundle, don't forget we've got XPRAT and the harmonics for the signals. In this case we're taking the harmonic signal, but remember we're looking for divergence cloud confirmation for the short, and that comes in where my cursor is right now. This is the little red triangle here. So this is the divergence cloud confirmation for the bearish move, and that candle closes just below this A pivot. So this is our entry just below this confirmation. So we've had signal and then confirmation. Where would our stop be? So this is quite a big trade. Okay, we need to really be aggressive with the stop above the B pivot here. Why? Because it tested this when it bounced off this support initially. So if it does go through that point, it's going to continue to go up and test here, and we don't really want to get involved in a big loss there. So we need to be reasonably tight with this, and that makes sense. We're just above this B pivot. It was tested there again, so it's been tested twice. So that's a sensible position for our stop. The next thing we do, what's the risk reward to the next support zone? Because we've already framed that chart. We use the fib extension, stop, entry, entry. Okay, So we're 1 to 1.6 into that zone. So that's a decent risk to reward. So if we were risking $1,000 here, for example, we'd be looking for a reward of $1,600 into that support. So that risk to reward is good. Let's get rid of that so we clean up, keep the chart clean. So really we got the entry, we've got the signal, we've got the confirmation from the divergence cloud, we've got a sensible entry under these pivots, and we've got some fresh air down to this support zone. Okay, now we're not going to get out of that support zone because this new indicator, which is my trade management brain if you like, it's called the manager. It's these dots above and below, the colored candles, and then this bias cloud. So we're on the hourly time frame, so we need to be on moderate with this when we start off, maybe even conservative, but for me moderate is good enough. So we got this entry at this point here. Now the dots below that are blue, they're lower than average volume, those candles. The dots above with the cyan, they're higher than average volume. So what we do when we get this first entry is we've got this low volume move down, but we do get some momentum building with these distribution candles. So these three red candles mean they're increasing in volume. This last one actually did have higher than average volume, so we were getting some sort of momentum after we entered into this trade, and then we pulled back to test this previous support as resistance. Higher than average volume, higher than average volume. We got a green candle here, green candle here. Let's zoom in a little bit. We need to talk about this, we need to understand what's going on. So this behavior means we've got a high volume rejection, we've got an accumulation candle. So this candle has more volume than this previous one, where the cursor is. It rejects the lows on high volume. This could come back and haunt us, but we've got to stop in there. Let's just let it go. Another higher than average volume, then we get higher than average volume, but a rejection of those highs, a big candle there, and a good 618 rejection of those highs, followed with a lower low, lower high candle, higher than average volume. Then we're going sideways, but lower than average volume. You see here, the cloud is still red. Then we get a distribution candle, red, so it's higher volume than this one. Then we get another distribution candle with higher than average volume, and then another one. You see that momentum really starts to push now. We get a higher than average volume distribution candle trying to push through this support, and then these cyan candles, they're downward candles, but they're actually dropping in volume compared to each previous candle, but they're still higher than average volume. We're still good. The cloud is our conservative, so if the cloud turns green, we get out of the trade, or we get some big bullish momentum, 2 or 3 green candles with higher than average volume, and we'll talk about those when they appear. So this next thing is, this is very important here. This is the behavior. This is the manager telling you. So you've already framed your chart. It's come down to test this support zone. Now it's pulling back against the bearish move with a lower than average volume. So this is a low volume pullback. Pulls back to this previous support and resistance zone. It's now acting as resistance into our red cloud. Then we get higher than average volume red candles. So their distribution, there's more sellers in the market, and they sell again and again, and eventually they push through the next support zone. Then we go sideways, but lower than average volume. Don't panic. You've got to listen to the manager. He's the boss. He's telling you not to panic because he's understanding the behavior. You just need to learn what that behavior is represented on the chart, and these blue dots below, lower than average volume. Then we start to come down again, higher than average volume distribution candles. There's more sellers. Now we get a low. Now all of a sudden we get an accumulation candle. There's more buyers than the previous candle, and it got higher than average volume. Then we get another accumulation candle, more buyers coming in than the previous candle, higher than average volume. A third candle now, higher than average volume. We need to be thinking about getting out after 2, in my opinion, but when you get 3, this is the time to get out at that close there. So that's the trade. That's the trade management giving you the aggressive exit from this trade to take your profit. When you've got these 3 accumulation candles, higher than average volume, this thing's going to push up. It did go sideways for a while, then eventually pushed up, but then you see that conservative exit is when that cloud moves from red to green here. So in essence, because of this sideways action, you didn't really lose a great deal. The profit was slightly better with aggressive, but for me, 2 candles higher than average volume that are green, we get out. So this is how to manage that trade right from the onset of having that amazing. I mean, this is a TradingView version. It's available for lots of other versions. This auto harmonic pattern completes in the automated completion zone. This automated completion zone is a mixture of lots of different fib levels taken from all of these pivots, and it's saying to you, this is where that D pivot should complete within this zone of price. And when it does, it's a high probability move down, but then we still need confirmation. So part of that day trading bundle is this divergence cloud. You see this red cloud down here, but the start of that is that red triangle pointing down. That's our entry for this trade. And then we switch to the manager and we manage this trade. I mean, this trade sensibly managed. I've got to move down. I've got to move the chart down even further here. So let's just measure this ticks. It's $12.50 per tick on copper, and getting out aggressively, that's 560 ticks. This is a big trade. Yes, it's a big boy trade, but this can be used for micro gold, micro ES, the same thing. Again, with a day trading bundle, you've got 2 signal generators, the harmonics or the exprat. They're 2 different types of strategies, 2 different types of signal strategies, and it gives you more opportunities to get in the trades, different trades. And then you've got extra to the day trading bundle, this new the manager, which maximizes your profit and keeps you in and doesn't let you panic when you get these lower than average volume pullbacks. The cloud remains red. You understand what's going off. I'm also going to put in the description of this video a link to the manager training video, which is very simple, simplifies it, and it was done live, so there's some questions in there as well that I answer. So again, this is a very, very simple strategy. It looks complicated, but we've simplified everything with the harmonics, with the exprat, with that divergence cloud for that confirmation. So it's signal, confirmation, manage, and the manager really does help to try and maximize those profits. Hopefully this has been informative, and you can understand a little bit more how our indicators work from inception to actually to finishing and closing those trades at maximum profits.